Hello and welcome to another episode of Eye on Mortgage. I'm your mortgage broker, Keisha Johnson, licensed under Royal Dominion Mortgages, and my company's RTS Mortgage Financial. Today we're going to be covering the product Bridge Mortgage. A bridge mortgage actually gives you the opportunity to access the equity in your current home so that you can use it as a down payment on the home that you'll be purchasing. Sound interesting? Stay tuned. We're going to break it down for you. Welcome to Eye on Mortgage, where we keep you updated on what's happening in the mortgage industry and what you need to know about the mortgage process. Are you a first-time home buyer? Looking to refinance? Interested in a private mortgage? Perhaps you want to know more about purchasing a new build or the reverse mortgage product. Whatever your interest, stay tuned to Eye on Mortgage. Oh, and please take a moment to like, share, and subscribe. All right, so a bridge loan is basically a short-term loan that allows you to take out money from your existing property to purchase a new property without actually selling the current property that you're in. All right, so it's basically it allows you to take equity out of the existing home so that you can buy a new home. It basically bridges the gap between the sale and the purchase. Or the sale and the purchase of your new property. So for most lenders, the existing property should actually already be listed. It should already be on the market. Also most lenders will allow you to get into a bridge mortgage up to a year. You want to make sure that you have at least 20% equity in the home, all right? And most lenders, once again, it differs, varies depending on the lender, but they'll allow you to take out, up to $200,000. The interest rate that you're looking at for a bridge mortgage would be prime plus 4. So if the prime is 2.45, plus 4, then the interest rate that you're looking at is 6.45. All right, you're in a pretty good position if you already have an offer on your home. All right, because at least with that, you already know the exit date based on that firmed up offer with with the sale of the current property. So you're in a pretty good position where that's concerned. Now, if the home is not sold within that bridge term, you may find yourself in a situation where you actually have two mortgages. Most lenders will allow you to defer the payment until the end of the term. With the bridge mortgage, you get to continue making the payments on your old home without having to make payments on the new home until, of course, the end of the bridge term. So you'll be paying interest on the bridge loan, but it won't be coming out of your pocket during the term of the bridge loan. As mentioned before, most lenders will allow those payments to be deferred until the end of the bridge term. So benefits of a bridge mortgage, of course, it allows you to access the equity in your existing home so that you can use those funds to put down as a down payment on the home that you're looking to purchase. So, you don't have to worry about waiting for the closing because, you're selling your current home. You need those funds to purchase the new home. So this allows you to access those funds a little bit earlier instead of having to wait until that property has closed and you get all those funds through closing day. You don't have to worry about that. You have access to those funds a little bit earlier through a bridge mortgage. Also, no need for renting or double moving, because if you have to rent while you wait, then of course you're having to move into the rental home and then move again finally into the home that you have purchased. You also eliminate, of course, having to pay two mortgages based on the bridge mortgages. Less, of course, something happens, as I mentioned before, where for some reason the purchase falls apart with your existing home. But other than that, once again, lenders do allow you to defer the payments so you don't have to worry about paying two mortgages. You can also use the funds from that bridge financing to possibly do a little bit of renovation in the new property before moving in, if that is something that you might need to do. So the negative side to bridge financing is the fact that the interest rate is a little bit higher, doubling up on the interest rate based on this type of product. You're looking at prime plus 4. In this market, you could be looking at around maybe 6.45 in terms of what that interest rate is going to look like. Now, you could look at it, if we look at it from the standpoint of if you had to actually move and rent, right? It may make sense because you don't have to move into another home and wait and, rent in the meantime. So, if we factor in the fact that you don't have to rent a property, right, until you move into your home, then once again, that interest rate may make sense in that regard. Now, you also want to put into consideration the double closing cost that will come with bridge financing, because for the bridge, there's going to be a closing cost for that, and then there's the closing cost for the property that you are actually moving into, the new property. There's a closing cost for that as well. So there's a double closing cost based on that. Now, the other thing, and I've mentioned this before, is of course if the current property that you're living in, if that deal falls apart, then you may end up having to extend the bridge financing if the lender will allow it. And of course, you're looking at more cost, or you may end up with a double mortgage, right, based on that type of scenario. So those are the things that, of course, you want to consider. All right, so allow me to break it down for you. So let's say that you are borrowing, you want to take out $100,000 out of your existing property. That's the equity, that's the amount that you're going to use for the down payment on your new property. All right, so typically what we're using as the interest rate would be prime plus 4. So prime 2.45 plus 4%. We're going to be using a interest rate of 6.45 for us to actually calculate what your payment is going to be on this bridge mortgage. So what we'll use is, let's say, so 100,000, which is the amount that you want to take out, times 6.45, which of course is the interest rate that we're using based on the bridge mortgage. And so your payment for the year, so we're looking for a payment, what the bridge amount would be for the year would be $6,450. All right. So let's say you don't want it for a year. Let's say you just need it for 90 days. You just need a little bit of a bridge for 90 days. All right. So what we would do with that is the $6,450, we would divide that by 365, right? Because there's 365 days. And so the daily payment on that would be $1,767. All right. So with $1,767, we're gonna times that by 90, because we only need it for 90 days. Remember, right? So in that case, the 90 days, for what you'd be paying for 90 days, I should say, on a bridge mortgage of 100,000 would be 1,590. All right. So that is what you'd be looking at. Now there is a admin fee anywhere from 200 to 500, depending on the lender. But this should give you somewhat of an idea of what the cost would be if you were to choose to go ahead with a bridge mortgage. And with the calculation that I've showed you, you can certainly use that as a gauge or as a guide to calculate any other situation that you might be in. Maybe you're only looking for 30 days, maybe you're looking, for a little bit longer than 90 days. You can use this breakdown, of course, to kind of have an idea, as I said, with regards to what that bridge amount is going to be. All right, so I hope that helps you. Hope overall, that everything makes sense. By all means, if you have questions, always feel free to reach out. All right. At the end of the day, you have to take a look at the pros and the cons, and of course, make the right decision for yourself and of course for your family as well. Until next time, have a wonderful rest of the day.